So yeah, beautiful people, it's your mentor, JPY here, and welcome to another YouTube video with me, where we are going to be continuing with the journey to becoming a profitable trader, where I myself, JPY, will be helping you with developing yourself your own trading solution. So on today's video, we are going to be moving into a very important chapter, which is trading skill. The first chapter that is very important. So on today's session, we are going to be outlining some of the key things that you need on your trading system or trading strategy, how to approach the market, patterns, and any other things that are very important that can help you see the market differently, from market structure to entry model to exit model to patterns and any other things that are very important. Without wasting any of your time, please make sure that you hit that like button and you subscribe and hit that notification bell, so that when I drop these videos, as you can see, that is more of a series now, you can be notified. Another thing that is very important also is comment section. I want to see you guys talking with me there, especially on this session here, on what is that you've learned and what is it that you'd like me to talk about, right? Not personal things that are aligning with what I'm doing. Another thing that is very important, guys, is on the description section, please make sure that you join the free group, as I'm gonna start sharing some of the documents or the information that I'm gonna be talking about here on the group. And then create your Access account, fund it with $300, send me a DM afterwards, and let's work. Other than that, let's get into this video. But before we start with the whiteboard section, let's actually go into the chart and check what is that gold did from what we spoke about last time. Let's get it. So yeah, good people, moving on this part of the section or this video, we are going to be talking about what is it that gold did from the past analysis that we had. So just to give you guys a brief of what is it that we're anticipating on gold, we saw that gold was on a bullish structure, creating a series of impulse correction, impulsive movement, a big correction, and then we're looking for an impulsive movement to the upside, right? As you guys can see that every single time price impulse, it needs to correct back to a demand area, push up, eliminate the high, and then from there it creates some form of internal range liquidity and then eliminates all the types of liquidities, taps into our demand. We identify the demand and then we look for buying opportunities to come and eliminate that high there, right? So with our previous analysis, one thing that came to our attention was that since our gold was on a bullish structure, we're looking for buying opportunities on the demand that we've identified within this area. But what really interested me the most was how we looked for selling opportunities so that we can be able to tap into our demand area and then impulse to the upside afterwards, right? So I wasn't that actively trading this week, hence why you wouldn't, if you've been following me on any other social media, Signal group or mentorship group, you know that I haven't been posting a lot, right? It is because of I'm busy developing something that I need to use in the long run. But just to give you a brief of how you are supposed to have approached gold, actually, this is what you are supposed to do, right? So the first thing that we managed to see and spoke about was that since our gold was on, since our gold was on a correctional phase of the market, it's risky for you to look for selling opportunities because of they have the highest chances of actually not respecting our setup. But it's advised for you to buy on the correctional phase on the end of the correctional phase of the market, which is where the impulsive movement starts, right? So what is it that we saw? We saw that since this guy was on a bearish correctional phase, we identified the supply area here that it's gonna push price down to the demand area, and even once price eliminated this low here, we then saw that there'll be a massive retracement back inside for price to come eliminate our temporary high, tap into our supply area, and then push to the downside to come and eliminate the low. So what I'm trying to show you guys here is this, that when price is on a bullish structure and then it goes up to eliminate the high, comes back down, takes the low out or respects the demand, pushes to the upside, and then pushes back to the downside, just note that there are high chances that price will respect the supply area, push to the downside, because of there's an untested demand that price has to come back to, tap into that demand, and then we can start rallying to the upside to come and eliminate that high, meaning that we are most welcome also to look for buying opportunities within this phase of the market, because of that's where the impulsive movement of the market occurs, right? These selling opportunities here, they are good, but they are kind of risky. So the A setup is basically us looking for a buying opportunity on a buying market, right? From then, since all that was our selling opportunity, truth be told, there was a demand that we identified on 7 minutes that price eliminated. But since all the demand was violated, it doesn't mean that the setup is invalid, right? So what I've seen from most of my students, what they did was that they switched and looked for buying opportunities on the impulsive movement as price corrected and then started impulsing to the upside. So what they did was they looked for buying opportunities to impulse with price to the upside, right? So let's just remove this and use a box actually. So this was the demand area that we've identified, right? So the demand area that we've identified, price tapped into it and then impulse to the upside. And then from there, what is it that we can see? We get our first impulse correction, our impulsive movement, price corrects to a demand area, taps into a demand area, start giving us that impulsive movement, eliminates a high. There's a possible demand area here that price might have tapped into. And then from there, we also get what? A big impulsive movement to the upside, right? Price comes to eliminate this high here, comes back inside for a 30 minutes demand area, right? And then from there, price flies to the upside, even when price has tapped into this demand area here. Guys, you need to be, we'll talk about this thing actually on the board. The power of impulsive and correctional movements, right? Price eliminates a high, comes back down, it starts pushing to the upside. There's a demand area here, price impulses, eliminates a high. After eliminating the main high, what does it do? Maybe let's say it finds another demand area here, pushes up, eliminates a high, finds a demand area. You see, it's just one thing over and over again until actually gold created what? Its all-time high. So this was one hell of a beautiful setup that we've identified from gold, right? Yeah, so just moving on to other things, let's go check how German data is currently doing, because we had an analysis on German data. Let's just go to a daily time frame, because that's where our analysis was from, right? German data, yeah, it's slowly but surely the guy is pushing to the upside, which is waiting for him to come and eliminate this area. The main objective of this analysis was quite simple. Your range low, your range high. What is it that we're looking for? We're looking for the equilibrium phase of the market. Price broke below the equilibrium, tested a resistant area that became a support now, bounced on it, and then we are looking for buying opportunities within the markets to go and eliminate that high. The same thing with all of the indices, right? Nasdaq, we saw the same thing, that the resistant area, price tapped into it. And then US state also, we're anticipating the same thing, right? So all of these guys, we are just patiently waiting to see whether are they gonna continue pushing up, or we're gonna get a big test inside of this area here, right? Without wasting any of your time, let's just go straight and build ourselves our trading system. So yeah, beautiful people, welcome to the whiteboard section. As I've mentioned, that today's session is going to be about us trying to talk about some of the components that you need in your trading strategy that can help you profit from the market, right? How you need to approach the market, the structure of the market, where the market is going to go, not really where it's going to go, but what information are you supposed to accumulate from the market, and what is it that you're supposed to do, right? As I've mentioned previously, that okay, when we think of a strategy or technical trading, we should think of what? A pattern, right? A pattern. When we think of what? A trading strategy, we should think about a pattern. And then I went on and explained to you guys that okay, when we say you are a profitable trader, profitability is what? The implementation of what? The implementation. It's basically the implementation of what? The implementation of your trading pattern. How consistent you are with implementing your right? How consistent are you with implementing what? Your trading pattern. So this means that okay, as much as this thing plays 10% of your trading overall structure, when it comes to trading skills, when it comes to risk management and other things, it's very important for you to understand that okay, if you implement the strategy in the right way, you will have the higher chances of actually profiting from the market. But the number one problem that I've actually understood from you guys is that you tell yourself that okay, you're gonna be using a specific pattern, you don't have a set of rules that you're gonna actually be using to execute this pattern, you don't have a well-designed plan on how you are actually going to be using this thing. Some of you guys are actually new into this trading thing. So one of the best things about this video specifically is to help you understand how to approach the market from a different perspective, from just try to unlearn what you've learned and try to actually do what I'm doing here, because I've traded your support and resistance, I've traded your ELOT waves, I've traded your SMC, advanced SMC, I've traded Nasdaq alone, I've traded all these different types of concepts. So whatever that I'm doing here is that I've actually collected all the information, summarized it, made it as simple as I can, so that we can be able to build something that is quite proper for you and me, right? So without wasting any of your time, let's start with some of the key components that you are going to actually be in need of when it comes to building your trading system, right? So one of the most famous chapters that each and every single trader needs to understand is this, right? Which is your trends, right? Each and every single strategy needs to have what? A trend. Why a trend? Because of a trend is the direction of the market. Without actually understanding the direction of the market, it's gonna sometimes be difficult for you to know whether to buy or sell, right? Another thing that you need to understand is what is the structure of price, right? The structure of price, right? We need to be able to identify a specific structure, right? Guys, note that there are different types of structures. There are different ways that individuals interpret the market, but one of the ways that even on the internet is exposed to everyone, a trader can be able to identify their structure is by simply going through the trend structure, right? So this guy here is quite similar to him, right? It's just a matter of your high highs, high lows, the instructions and the rules that each and every single trend needs to have. And then moving on, what the other important chapter that we need to focus more on is what? It's waves, right? We need to invest our time in waves, right? Waves, our impulsive and correctional movements. The importance of waves. Why are waves very important? The reason why we are investing our time in understanding waves is because of we need to understand where the market is currently at. Waves are very effective, right? So imagine knowing the direction and knowing where the market is going to be. So this means that, okay, it makes it simple for you to know exactly what is it that you as a trader you're supposed to do in terms of buying or selling or using a specific pattern. You don't want to find yourself knowing the trend but not knowing the wave, because if you don't know the wave, it's going to be difficult for you to know whether you're supposed to implement a buying structure or a selling structure, right? And then after understanding our waves, what is the other thing that you want to understand? Let me see, we have the trend, we have the structure, we have the wave, and then let's actually talk about the entry model, right? The entry model, right? We're going to talk about the entry model. So there are different types of entry models that a trader can use to actually profit from the market, right? Which I'm going to be disclosing to you guys. So we have a set and forget and what we call the step trading, right? So I think for now, this is the information that we can use to actually build something that is proper for now. Nothing hectic. I have my own edge and I don't want to expose it, guys, unfortunately. So what we're going to be doing is that, like I said, the purpose of this thing is for me to help you modify whatever that you're doing so that it can become something that makes sense. Okay, so moving on, we're going to start with what? We're going to start with trends, right? We're going to be starting with what? We are going to be starting with trends. So as you guys know that, okay, there are three different types of trends within the markets, but the ones that we are most likely to be interested in is our uptrend and our downtrend. So we have what? We have our uptrend, and we also have our downtrend, right? So like I said, a trend is basically what? The direction of the market, right? So what is an uptrend? So an uptrend occurs when the market is moving to the upside, right? When the market is pushing to the upside. So the minute you see the market pushing to the upside, know that, okay, you will find yourself in what we refer to as what? As an uptrend, which means that, okay, a downtrend will be basically when price does what? A downtrend will be what? When price is pushing to the downside, right? So this is the basic and simplest way we can do it. We can be able to explain what an uptrend and a downtrend is, right? But one thing that I want you to pay attention to now is this. Each and every single trend has what you call rules and properties, right? Each and every trend has what you call the rules and the properties. right? Each and every single trend has what you call the trend rules, the rules, and also what the properties, right? So what are the properties? So the properties are the components that formulate the trend. So those are the components that formulate the trend, and then the rules are basically what the instructions that a trend needs to follow, right? That's what the instructions a trend needs to follow. So a rule is what? Instruction. And then a property is basically what? A property is your component. Right, so we have what? An instruction and a component. So let's say that, okay, we are currently on an uptrend. What would be the properties of an uptrend? What are the things that makes an uptrend? So what makes an uptrend is a series of what? Is a series of higher highs. It's a series of higher highs, right, known as HH, and then abbreviation, and then higher lows also. Right, higher lows, HL, right? So these are the properties of what? The properties of an uptrend. And then moving on to the instructions. What is it that an uptrend is instructed to do? How do you see that an uptrend is actually an uptrend? You will see by the following instruction. If you find yourself in an uptrend, you'll normally see price breaking what? You normally see price breaking your higher highs, and then price will not end for not break your what? Your high lows, right? So the properties are the components, which are your higher highs and high lows, and then the rules are your instructions, which is price will normally see it eliminating your highs and not eliminating your lows. So these are some of the key valuable things that you need to understand about these trends, right? And then moving on, what is it that you also know about a downtrend? A downtrend, like I said, the properties are the components, the rules are what? The rules are the instruction. So, hey guys, I bought a permanent maker by mistake, so yeah. But unfortunately, we have to use it, which is to erase it with using our sanitizer. Properties, right? The properties will definitely be what? Will definitely be our lower lows, which is our LL, and then the another one will be what? Our lower high, right? Our lower high, LH, right? So these are the properties, which are the components that formulates what? That formulates a trend. And then when it comes to the rules, like we said, the rules are the instructions. What are the rules of a downtrend? And downtrend has been instructed that it should always do what? It should always break your lower lows, and then it should not break what? Our lower highs, which means our highs are protected, our lows are weak. Here, what is it that we know? We know that our highs are the ones that are weak. Our highs are the ones that are weak, but the lows are the ones that are protected, right? So this is the basic information that you can find about what? An uptrend, right? And a downtrend when it comes to both these types of trends. So I hope you guys are writing this thing down. Now I'm going to be showing you guys the types of structures that we are going to be focusing on. So yeah guys, moving on, forgot one important rule. The rule says that every single time you find yourself on an uptrend, right? Every single time you find yourself on an uptrend, you should strictly look for what? For buying opportunities, right? And then every single time you find yourself on a downtrend, strictly look for what? Look for selling opportunities, right? You should look for selling opportunities every single time you find yourself in these types of structures. So this will help you actually with order flow and price alignment, because of one of the key mistakes that you guys make is that you tend to look for selling opportunities on an uptrend and then buying opportunities on a downtrend, right? Which we'll talk about when time goes on. And then moving on, let's talk about the structure now. The structure, right? Let's talk about structure. Right, we want to discuss both structures for what? For uptrend and downtrend. Right, let's start with what? The simplest one, which is an uptrend structure. So on an uptrend structure, what I want us to understand is the following thing. The first single thing that you have to do as a trader is to identify the trend that you're in, right? By firstly looking and seeing that does price align with the properties and the rules of a trend. So which means that, okay, when we start, we're gonna start with what? The properties. Right, properties. Can we spot our higher highs and high lows. But now what I want us to do is I want to simplify things for you. So instead of saying that, okay, you have your higher highs, you're gonna call them swing highs, right? You're gonna call them swing highs. We're gonna call them swing highs, and then high lows, we're gonna call them swing lows, right? We're just changing terminologies now, right? And then the rules, we know that, okay, highs are weak, swing highs are weak, SH is equals to weak, and then SL, which is swing low, is equals to strong, right? So a typical example of an uptrend, you're gonna find yourself with something like this. So this is what we refer to as a textbook example of an uptrend, which means this, you can find it almost everywhere. So if you find yourself with a diagram like this, what you need to firstly understand is that, okay, you need to be able to identify what your swing points. Like I said, the top part is what is your swing highs. So swing high here, and then swing high here, and then the lows are what? Swing lows, and then another swing low here. So since we saw that these are our swing highs and then these are our swing lows, we go back to what? To the rules. What are the rules saying? The rules here are stating that, okay, every single time you find yourself on an uptrend, the highs are gonna be weak, which means price is always gonna be looking forward to doing what? To eliminating our highs. But then with lows, the lows are always gonna be the ones that are protected, right? Meaning that this low will not take out this one, and then this low here should not take out this one, as you can see, and then this low, this one mustn't take out this one here. So that's what the strong and everything means, right? So this is a typical example of an uptrend. So just to do a summary for you on this, if you want to explain this thing to someone, or you want to get to understand the information, what you want to tell the person is this: an uptrend occurs when the market is doing what? When the market is pushing to the upside, creating a series of high highs and high low, which can be defined as our swing highs and swing lows. Every single time we find ourselves on an uptrend, we are looking for buying opportunities. And then what an uptrend, how an uptrend behaves is that highs will always be eliminated, so which means we're always gonna have breaks on highs, and then the lows are always gonna be the ones that are protected, meaning that price won't always eliminate the lows. That's the simplest and effective way to explain an uptrend to someone, right? Moving on, let's talk about a downtrend. So a downtrend occurs when the market is pushing to the downside, right? Just to give you guys a quick example of a downtrend. So a downtrend occurs when the market is doing what? Downtrend. When the market is pushing to the downside. So if price is pushing to the downside, this means that, okay, this trend is gonna have the properties and then also the rules, right? The properties being what? The properties being our lower high plus our lower low. Like I said, we're changing terminologies. Where we have our lower high, we call it what? Swing high, and then where we have our lower low, we call this swing low, right? And then the rules, they are quite simple also. And now we know that, okay, we are also going to be involving this one here. So when we see a downtrend like this, what are some of the things that we should start with is our properties. What are our properties say? Our properties say that, okay, these are going to be, so our swing high, right? Swing high here, our swing high here, our swing high here, our swing high here, our swing high. This thing, the board is wet. Our swing high, see now I'm making that mistake. This is our swing low, swing low, swing low, swing low, and then another swing low, right? So these are the properties of a downtrend. That every single time you find yourself on a downtrend, you're normally gonna see price creating our swing highs and then our swing lows. And then what this means also is that the rule states that lows are always gonna be the ones that are gonna be eliminated. So as you can see, the lows are eliminated, and then the highs are the ones that are protected, meaning that this high won't take out this one, this high won't take out this one, this high won't take out this one. So the highs are the ones that are protected, right? So the same thing. Every single time you find yourself on a downtrend, you wanna do what? Look for selling opportunities on this trend. The simplest way to explain the downtrend again is by simply telling someone that every single time you're on a downtrend, you'll see price pushing to the downside. Our main objective is to look for selling opportunities, but price will be creating a series of lower highs and lower lows, which can also be defined as our swing highs and swing lows. And then moving on On a downtrend, what we normally see is price eliminates lows, and then our highs are always the ones that are strong, right? So this is a typical example of both our uptrend and downtrend structures. So now we'll be moving on to actually understanding waves, right? Another very interesting chapter, right? So yeah guys, moving on, let's talk about waves, right? I want us to now speak about what? Waves, right? I want us to talk about waves. So there are two different types of waves that I want us to talk about, which is what? Our impulsive and correctional wave. So I'm gonna try also make this information as simple as possible, right? We have what we call an impulsive and correctional wave. So before we go into that, we have to first understand why is a wave very important. So the reason why you need to understand the importance of a wave, it is because of you need to actually understand where price is. So by understanding the wave, you actually get to understand where price is and where your next movement might be, right? It's very important because of if you have the trend and you don't actually know where you are at the moment, you can be on an uptrend on a daily time frame, but when you switch to maybe a 15-minute time frame, you find that you're on a bearish structure. So you need to be able to align these things so that you can be able to understand. So that if day one is an uptrend, but on H4 price is going down, and then on 15 minutes price is going up, and on 5 minutes price is doing this thing, how do you actually get to align all of them and then get the direction that you're looking for? As I've mentioned, waves, we have two different types of wave, which is our what? Our impulsive wave, impulsive wave, and correctional wave. Our correctional wave. Right? An impulsive wave is a wave where we see price takes the overall direction, the overall direction of the market. This marker won't be as clear as it is because of this side is still wet. Take the overall direction of the market. Right? Price takes the overall direction of the market, and then here on a correctional wave, what is it that we see? Price goes against the overall direction of the market. Right, price here, it takes the overall direction of the market, and then on this one we can see that okay, price does what? Price goes against, here it takes the overall direction of the market. Right? What does this mean? This means that okay, if you find yourself on an uptrend, right? Let's say maybe you find yourself on a bullish structure. If you find yourself on a bullish structure, something like this, right? If you find yourself on a bullish structure, this is what a bullish structure looks like, right? A bullish structure, you know, swing lows, swing highs, breaks on highs, and then strong lows and weak highs, right? If you find yourself on a structure like this, you come and check this information here. This one says that I take the overall direction of the market, right? I'm the impulsive movement. So this means that okay, if you wanna see the impulsive movement, this will be your impulsive movement. This will be your impulsive movement. This will be your what? This will be your impulsive movement. But then when we check the correction says that why is this thing an impulsive? Because of it's taking the overall direction of the market. Price keeps buying on these areas here. But then when we check the correctional wave says that I go against the overall direction of the market is what? The overall direction of the market is it's a buying market, right? Price is pushing to the upside. But what is it that we see here? We see price pushing to the downside within the structures here. So this means that okay, these are our correctional wave. This is our correctional wave. The market is going against the overall direction. The market is bearish within this phase here. The market is bearish within this phase. While the impulsive movement is the one that is responsible for what? The impulsive movement is the one that takes the overall direction of the market. This one keeps taking the overall direction of the market. So this is how we get to implement these types of waves. So in simple terms, on an uptrend, what are you gonna have? An impulse, correction, impulse, correction, impulse, correction, which means after this, you are gonna be able to get what? You're gonna be able to get an impulsive movement. Hence why I said that with waves, you get to actually understand where you are first, and then you will get to know where you are going. For example, if price is doing this, we know that the low is protected. If the low is protected, this means that okay, price is correcting to the downside. We'll then see an impulsive movement to the upside without eliminating this low, right? So this is how we get to actually break down our impulsive and correctional movement on our uptrend, right? For a downtrend structure, it's the same thing, right? It's just the same thing, but differently, right? So what is it that we can see on a downtrend? Price will be doing what? Creating a series of swing lows, swing highs, lows being eliminated, and then highs remaining strong. And then we come back. Impulsive says it takes the overall direction of the market. The overall is a bearish market, which means now this will be your impulsive movement, this will be your impulsive movement, this will be your impulsive movement, this will be your impulsive movement. Now, moving on, this definitely means that okay, this area here is going to be considered as what? As a correction. Why is it a correction? It is because of here price goes against the overall direction of the market, right? Price is bearish, but here we see this small bullish movement here. We see price creating what? This small bullish movements here. This small bullish movements here. This small bullish movements here. They are going against the overall direction of the market, while the overall direction of the market is what? Is a bearish market. So on a downtrend, what is it that we know? Impulse, correction, impulse, correction, impulse, correction. Which means when you log into your chart and you see price somewhere around this area, what should come back at the back of your head is that okay, I'm on an impulsive movement. Another thing that I want to add towards this thing is this. Every single time we are gonna be looking for buying opportunities, we are gonna be strictly looking for our opportunities on what? On our impulsive movement. So on an uptrend, we'll be buying on the impulsive movement, and then on a downtrend, we'll be selling also on what? On the impulsive movement, which means our first entry will definitely be what? Our POI, our point of interest. Our point of interest can be a resistance, can be a support, can be a fib, can be anything. Hence why it's called a point of interest. And then the second ones will definitely be what? Our impulsive movements, right? This is something that is very important. So now I want to break down price, right? I want us to go deep on price. Every impulsive movement, right? Since we'll be looking for buying opportunities and selling opportunities on it, has its own structure, right? Which means that's what we're seeing here. It's the overall structure. Within the impulsive movement, this impulsive movement here, within this major impulsive movement, there are other form of, what do you call this thing? Structures that is created within this movement. What I'm saying here is this. If you find yourself on an uptrend, she's gonna do this is the first structure, and then you create the second structure here. If you find yourself on an uptrend, what is it that you're gonna see? We'll see price impulsing up, correcting to the downside, impulsing, right? Let's just say impulses, comes up to eliminate the high, comes back to the downside, and then it starts impulsing until a high is eliminated. So I want us to talk about this impulsive movement here, right? That this is the overall movement, right? This is the overall impulsive movement. But within this impulsive movement, since we'll be looking for buying opportunities inside the structure, there'll also be other internal, let's just call them internal, impulsive, impulse, and correction. Right, there'll also be what? Internal, impulsive, and correctional movements. As you can see here, that okay, price impulses, correct, impulses, correct, impulses, correct, and then impulses. Which means that okay, on the impulsive movement, we'll be looking for buying opportunities within this areas here. We'll be looking for buying opportunities. Why? Maybe let's say we use the Fibonacci golden zone, or we use a support area or Fibonacci area here. This area here remains to be our main entry level. Our main entry level. Hence why I said that we'll be looking for buying opportunities on this area here, as this area as our POI, and then we'll be also looking for buying opportunities on the impulsive movement of an uptrend, which means on the impulses, the internal impulses. right? That's the other area we'll be looking for our buying opportunities from, right? And then the same thing with this very structure. If you find yourself on this very structure, just know that, okay, when price is pushing to the downside, right? When price is pushing to the downside, it will keep on creating this impulsive and correctional movements, right? It will keep on creating this impulsive and correctional movement. This whole structure is an impulse, right? This whole structure here is an impulse, but within this structure, you can see that there's an impulse, correction, impulse, which means we'll be looking for selling opportunities in what? The internal impulsive movement, right? The internal impulsive movement. So this is very important. Why? Because of, I'll just give you guys an example. Let me check this phone. We are back again. So now what we want to do is to do something called, maybe let's say, price alignment. We want to align price and actually get to understand what are some of these things that are very important that we can do that can help us to actually navigate price without having any form of problems, right? So what we're going to be doing now is that we're going to be talking more about waves, because of, like I said, waves play a major role, right? So let's take, for example, that, okay, we're just going to be doing a lot of examples now, right? Let's say that, okay, you're on an uptrend, price is pushing to the upside, right, pushing to the upside, and then price is currently here, right? So one of the ways that I've actually taught my students on analyzing is this. The first thing that they should do is to actually understand the trend that they're in, right? They should actually understand the trend that they're in. And then after understanding the trend that they're in, the second thing that you want to do as a trader is to know the wave that you're currently in, right? This is the overall. This is the overall wave that you're currently in, right? After knowing the type of wave that you're in, what you want to do is, from this wave, you are going to be focusing more on the internal wave. Right? You're going to be focusing more on the internal wave. What wave is that, right? So that when you know the overall wave that you're in, you'll be knowing the next wave that's going to be coming, and then inside the overall wave that you're currently in, what you want to do is understand where exactly price is, so that you can be able to go where price is going to go, right? From here, we know the trend, we know the wave. There are other concepts, there are other information that is very important also that we speak about. Okay, let's just talk about, okay, let's add these guys here. The premium, let's say advanced supply and demand. Let's call it advanced, advanced S&D. Let's call it supply and demand. Right? I'm not going to be talking about like the normal supply and demand. So on the chapter of advanced supply and demand, what we want to talk about is these three key levels here. Another area where most of you guys make most of your mistakes. So which is the premium, equilibrium, and then discounted. The discounted phase, right? So the premium area is an area where sellers are more dominant. That's where supply is mostly dominant. The equilibrium area, supply plus demand, they are what? They're equal, which means you normally see price what? Reacting here, right? Price will pass this area here without reacting. And then the discounted phase of the market, right? The discounted phase of the market, that's where demand is active, and then you know that demand is only active, or this is where we are looking for our buying opportunities. Let's say supply is active, or this way we're going to be looking for selling opportunities, and then this will definitely be where on a downtrend, because we sell on a downtrend, and then this will be where on an uptrend, right? So why is it important for you to consume this information? It is because of when price is at the premium, you don't want to look for buying opportunities. When price is at the discounted, you don't want to look for selling opportunities. And you should know that price wouldn't pass the equilibrium without any form of reaction. It has to react when it passes that. So for example, if you're on an uptrend like this, right? So this will be your premium, this will be the discounted, 50% of this will be the equilibrium. Equilibrium, discounted, premium, right? What we want to do is to look for buying opportunities on anything below the equilibrium going to the discounted phase of the market, right? Because of that where price is cheap. I always like to use this example of 10, 5, and 1. As a consumer, where exactly do you want to buy? When price is cheapest, from 4 going down to 1. That's the area that you want to invest your capital on, because of price is cheap there. You can't buy something when it's high, it's expensive, right? So which means once price breaks the equilibrium, we can then look for buying opportunities below the equilibrium, and then we'll then look for those long opportunities to the upside. Just know that you don't pass here without any reacting. This is the reaction I'm talking about. So you see, you're only interested in buying on the discounted phase of the market, right? And then the same thing with the bearish structure. You find yourself on a bearish structure, price eliminates your low. Guys, you don't need the break of structure to have this thing. Like this BOS theory to me doesn't exist anymore, right? So when I say a break on a high, I'm just reminding you of the things that we spoke about, right? So price will then push to the upside. This will be your premium, 50% equilibrium, and then the bottom phase discounted, right? Like I said, premium area, the only thing that is active is a supply, right? Which means that, okay, when price is at this area here, it's most likely to do what? To sell, which means you're going to be looking for selling opportunities within the structure. A supply or demand can be our point of interest, right? Some can use order blocks, some can use Fibonacci's, golden zone, some can be whatever. Just know that every time you are on an uptrend, your buying opportunities must always exist where? On the discounted phase of the market. On a downtrend, your selling opportunities must exist on the above the equilibrium phase of the market, which is the premium. And then price will break the equilibrium, play around before pushing to the downside, right? Like I said, it's 10, 5, 1. As a seller, let's say you're selling a product, you obviously want to sell a product at the higher price. You can see that anything from 5 going to 10 is expensive, right? So you want to sell them, right? Which means this is what? This is our premium area. This is our, let's say, our equilibrium phase of the market, and then you're looking forward to taking opportunities within what? The discounted phase of the market, right? Okay, we have the first step. So now we know that, okay, we have a trend, wave, and this. So we know that, okay, this is what? This is the impulsive wave, this is the correctional wave, this is the correctional wave, and then this is the impulsive. You're currently on what? On the correctional phase of the market, right? Guys, whether you're using trend lines, whether you're using whatever that you're using, just note that this information that I'm about to show you, it's very important, right? Let's say, for example, that, okay, we've identified our golden zone, right? This area here acts as our golden zone. We'll be looking for buying opportunities within this area, right? If we are using the golden zone, this basically means that since when we are on a correctional phase, I always tell you guys that it's risky for you to look for selling opportunities on a buying market, right? But for some of you guys that would want to do that, okay, I'm not gonna advise it for now. What we're gonna do, we know that we're on a correctional phase, but we'll be looking for buying opportunities on our point of interest, which is our, what do you call this thing? On our demand, not demand, golden zone. Guys, it's been a while since I've said the word golden zone, hence why I keep forgetting it. Let's say golden zone. Let's say you're going to be using a golden zone as an entry, right? Now, think about this thing in this way. If price taps into our golden zone, this means that automatically we're expecting price to shift from a correctional wave to an impulsive wave. This means that now, this is where you need to be smart. For those of you guys that are using your trend lines, this is how you plot your trend lines, right? You start plotting your trend lines like this. This means that, okay, you'll then be looking for a break to push with price to the upside. For those of you guys that are using, what do you call this thing? Patterns to trade, you know that there are patterns where price will be pushed. I don't know what you call it, a flag or what. You're looking for a pattern, a reversal pattern, right? This is where, when price shifts from, right, let's write this thing down. When price shifts or changes structure, what is it that you look for? We look for a reversal pattern. We look for a reversal pattern. Right, we look for what? For a reversal pattern. A reversal pattern for the price action, guys. For price action, let's just say price action. For price action, the one that I know can be at this moment an inverse head and shoulder. Can be an inverse head and shoulder, right? And then we can have a double bottom as a reversal pattern. What else can we have? I don't know what you guys call this pattern, man. Like this one where price does this and then it breaks and goes above, right? So this can be the types of patterns that you're gonna be using. For SMC guys, for SMC type of traders, what you're gonna be looking for, you're gonna be looking for your change of market character, which means you're gonna be looking for something like this, right? Or your shift of market structure, where price will respect your supply area, fail to take this low out, go up, leave you with a demand area, and then push up. So these are the areas that you want to invest your time on when we are shifting from a specific trend to a specific trend. But look, when we are shifting, we are only shifting when we are below the equilibrium. We are not doing anything above the equilibrium, right? Which means we'll then be looking for that type of movement. Price respects our reversal. It will start moving like this, right? So now you have to be smart and understand that we have shifted from a correctional phase of the market, right? We have shifted from the correctional phase of the market, and then now we are doing what? We are impulsing with price to the upside. What patterns are you going to look for? You move from reversal patterns to what? You move to continuation, right? Continuation pattern, right? We are moving to what? To continuation pattern. What are your continuation patterns for your price action, guys, right? For price action individuals. For price action, you know that, okay, for you to continue pushing with price to the upside, you can use your double bottom, right? You can use your double bottom for continuation. You can still use the same pattern, actually. You can use the same pattern, because I'll show you why we're using the same patterns also within this whole structure. Why are you using a double bottom and inverse head and shoulder and others, right? But we can use a double bottom, an inverse head and shoulder also for a continuation. You can use, I don't know what you guys are gonna call this one. Okay, where price does this, plays around, it impact. It's just the same thing actually. I can't lie. You can use the reversal patterns for continuation also. One thing I've realized right now is that you can use the same thing, unless if I forgot some of the patterns. Normal head and shoulder, you can't use it on a continuation. An inverse, you can't use it on a continuation. Support and resistance, you can use support and resistance. The basic way is to use your normal, like your horizontal. Okay, let's say your trend line touches, right? You can use your trend line touches, or you can also use your normal, your basic support and resistance. Right, you can use both these guys here. And then for SMC traders, you know that you're gonna be using your order blocks, right? For SMC traders, for SMC guys, you know that you're gonna be using your demand areas. It's just gonna be pure demand and supply, right? Or what you guys call OB, order block, right? Or even you can use your golden zone, right? So what is the JPY saying here? Price is impulsing to the upside. Within this impulsive movement, there are internal impulses and corrections. As you can see here, that there's a channel break, price pushes up. Impulse, correction, impulse. Every single time there's a correction. That correction, we are gonna look for, a reversal on that correction, so that we can keep pushing with price to the upside. Like I said, many ways to kill a cat. These guys, what are they gonna look for? An inverse head and shoulder at this area here. They're gonna look for a double bottom at this area here. They're gonna look for what? This type of pattern at this area here. The same way with the SMC guys, they can look for a change of character within this area here. Like, we only look for opportunities on the impulsive movement, right? And then one of the other ways that we can use is by using your Fibonacci, right? The Fibonacci is basically what? Your golden zone. You can easily see price pushing to the downside. Some will look for your order block, others would plot their Fibonacci from their high to their low, and then they get their golden zone, and then some will look for a reversal pattern instead of using anything. So which means within this area here, if you were to process this thing here, you're gonna find yourself with something like this, right? You're gonna find yourself with something like this. This is swing high, swing low, premium, equilibrium, discounted. Some would want to do what? Identify their point of interest, which is golden zone, order block, demand and supply. Some would want to look for a pattern instead of this area, which means even if price taps into the demand, some would want to do what? At this area here, they would want to look for a reversal pattern, right? On that reversal pattern, that's when they can be able to buy to come and eliminate this area. Look what we are doing. We are shifting from a bearish to bullish, and then on this bullish structure here, we'll be looking for buying opportunities. Even price will keep on doing the same thing over and over and over again, which means when price goes up, the same structure here, you can also look, which is this one, price won't move on a regular basis, like price will move like this also. You can still look for buying opportunities using this, your channels and any other form of things. the main purpose of this thing is to take your internal structure, utilize it to its fullest, right? Because this is a POI, a point of interest. Is it necessary? Not really. What's necessary is the reversal. Because if you don't get the reversal pattern, this means that, okay, some of you guys wouldn't be taking the entries, right? So if you get a reversal, this increases the likelihood or the chances of you looking for your buying opportunities on this trend here. So using those trends, we don't just look for any pattern anywhere. We look for reversal patterns on price reversing from a bearish movement to a bullish movement. Some, like I said, they would want to do what? They would want to, let's say price goes into the equilibrium, right? Let's say price goes into the equilibrium. Let me just fix this for now. Right, let's say price goes up, goes into the equilibrium, right? Some would see that, okay, oh, there's actually a strong reactional area here. There's actually a strong reactional area here. This is what? This is your support level. This is your support. This is your support level. Price is gonna bounce here and then keep going up. Guys, be smart, be smart. Look. I want you guys to see this thing. Look, if you draw a trend line like this, there's a channel break here. You look for a buying opportunity. So you're using confluence. A support, confluence, a break, confluence. You're looking for those buying opportunities, right? Think about it. And for the guys that are using major key, they know that every correction that occurs, right? They look for buying opportunities, looking for buying opportunities. But what we are doing now is we are understanding that we are buying within what? The internal impulsive movement, right? We're looking for buying opportunities within the internal impulsive movement, which means we don't want to buy anywhere, right? We don't want to sell anywhere. We're not interested in the sell structure, right? Because of, trust me, the high chance of you losing on a sell structure is very high compared to buying on an uptrend. This thing respects its alignment, right? So guys, I don't know. This sounds like something that makes sense to me. We are using reversals. On what? On our POI. On our continuation, right? On our continuation, we can also use reversals also, and you can also use continuation patterns. You can also use continuation patterns on that area. It's as simple as this. But we need to know that everything that you're gonna be looking for, any opportunity you're gonna be looking for, it needs to be below the equilibrium. Anything above you want, which means for those guys that are gonna be looking for buying opportunities, maybe let's say having a point of interest here, they're always gonna be eliminated. This is normally called internal range liquidity. Price has to eliminate all this form of liquidity created here until it reaches a specific level. I don't know if I'm making sense. 17 minutes. This is not good. Can't be giving you, but it's fine. This information is just way important for me and for you. So, for today, we are done. Right? This is the information that I wanted to speak about. Right? How to approach price and everything. Right? Let me just add one last thing. I'm so sorry. Like I said, when I say I have studied most of this concept, I mean it. See how I can incorporate this on this, that on that. Instead. So yeah, good people. So this is the end of our session for today. What we've discussed today was just the introductory part of the movement, actually, which we spoke about the following things, right? We spoke about building yourself a trading strategy, right? We spoke about trends, we spoke about waves, right? We also spoke about advanced S and D, right? So these were the three key main chapters that we spoke about today. If I didn't stop here, the video was gonna be too long. So these are the information that we spoke about. Here we spoke about our uptrend plus our downtrend. Here we went on and spoke about what our impulsive plus correctional movements. Here we came and spoke about what our premium, our equilibrium, and our discounted phase, right? So these were the three key main things that we spoke about. We went on and spoke about what? The rules plus properties. Here we spoke about what? The importance of what? The impulsive wave, right? The importance of what? Of impulsive wave, the internal the internal waves, right? And then here we just spoke about this thing, how price is easily affected by this. So we're gonna talk more about this thing when time goes on, guys. As for today, let's call it a day. We spoke about the following things, key major things. Spoke about patterns also here. We also spoke about what patterns and ways to approach price actually. We spoke about patterns also, right, within this area here, reversal patterns, continuation patterns, and how we can also look for specific opportunities within the markets, why we shouldn't be buying on a premium, why we shouldn't be selling on a discounted, what happens when price enters the equilibrium phase of the market, right? So from my side, this was a very informative session, and see you guys on the other side of the world, man. Wishing you guys nothing but all the best of luck. Go back, test the information if you want, and see you guys also in the comment section. Other than that, I, Tumelo JPY, your mentor, would like to call it, it's night now, a night.